Jerome Powell let the cat out of the bag today and basically confirmed that a September rate cut is certainly in the pipeline. And the icing on the cake is that the market did exactly what it should have done, regardless of a catalyst. There was no big technical blowup from a volatility perspective, which makes our job easier for the rest of this week. Welcome to the Trade Brigade Midweek Market Update. My name is Matt, and I want to show you what the market should do next. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. What do we see here from a trend point of view? Well, the trend is still technically down. We have highs, lower highs, and an opportunity for a lower high at the top end of today's range. And don't forget that we have lows and certainly lower lows. So if this is going to reject for a lower high and the trend remains down, ultimately the target would be to make an equal low, which is down here at 537. That would be a very straightforward trend analysis perspective here for the market. However, I don't think it's as simple as that, and it's for 2 reasons. Now, we'll start with the bear case because the trend is down and the structure is also bearish, right? We have a bearish inverted hammer where in the upper wick, sellers clearly stepped up and were able to push prices back down towards the halfback of today's range. Now, this location is also important because it represents a gap close from the Tesla and Google earnings debacle. It's also within striking distance of the upper edge of this week's expected move. So if the sellers are going to make it happen, if they're going to continue this trend in the downward direction, what needs to take place on the daily time frame is that this 4-day balance range needs to yield a look above and fail, aka a lower high back down underneath the breakout point. And notice how precise and equal all 4 of these highs were, every single one of them at 547. If we're seeing and spotting a lower high underneath 547, the equal low is the target on the daily time frame chart, 10 points lower, 537. That's the downside. Now, let's talk about why this is not necessarily the top of mind priority here, and it has a lot to do with, of course, Meta earnings after the close. If you guys can see on your screen, if not, I'll read it out loud in a second here, but the bid-ask spread in the post-market is currently 552.65, 58 by 72. Point being is that we are not dealing with a large gap down due to Meta earnings. We're not gapping down underneath that key inflection point at 547. So my first thought is that, all right, if the trend is going to change here on the daily time frame chart, and I get it, this is a little bit flip-floppy because we just started a brand new daily downtrend, right? But we know that markets over time tend to go up. So be very quick to change your mind from a bearish trend to a bullish trend. That's my take, at least after trading markets for years now. So in this case, if we're thinking about a daily trend reversal to the upside, notice that today opened on a gap up. The gap was closed to the downside, and we did find buyers off of the top end of the balance range and those 4 equal highs that we just described. So step number 1 walking forward is that we need to see a sustained hold over 547. If that's the case, then the next major step is making an equal high to the last lower high on the daily time frame chart, which would neutralize the trend. And then I think everybody could agree that this starts to suggest, right, here is your very classic, if we make the equal high up here, there's your classic inverted head and shoulders, any breakouts through this neckline, and this is sort of speculative at this point, but you get the concept of how the daily trend could possibly reverse in the upward direction on sustained movement and holds outside of 547 in the upward direction after some sort of equal high is presented at 557.50. So the easiest way to think about the daily time frame chart into the remainder of this week is what's happening with 547. If we're above 547, I would tend to maintain a neutral to slightly optimistic take or stance that the trend is at least capable of reversing. If we see a huge fade off of the open on tomorrow morning's Thursday session, and we find ourselves under 547 quite rapidly, it's nothing more than setting a lower high. For trend continuation, I would try to short up against this sort of lower high Brigade bolt under the 547 with the intent of looking for an equal low target, 10 points to the downside. So think in terms of tens. 537, 547, 557, 50 and 50 cents up there at the top end. All right, that's the daily analysis. I do want to provide a little bit more context, which maybe supports the bears a little bit further. We do have this channel, which has, of course, been broken. We talked about the breakdown there, but this is a perfect back test of the support trend line. If you're thinking, Matt, this is nothing more than a back test, it's going to be look above and fail, that's fine. But please just respect 547. The other reason that this is providing decent confluence from a resistance perspective is if we throw on a 20 SMA, we don't oftentimes look at these, but this is a 20 simple moving average, right? That upper wick is rejecting the 20 SMA. This is a clear change in tone out of the market, which had been riding the 20 SMA in the upward direction, and now we're below, possibly threatening that lower high. So bears are trying to hang on to these data points, but I would still maintain the sort of more conservative approach, which is just that for the short to actually unfold back to the equal low, as a trader, we've got to be underneath 547. Right? That's my take here on the daily. Let's drop it on down to the hourly chart, get a little bit more nuanced and granular. First thing to talk about is that any shorts from in this box are feeling the pressure. And this is always like, put this in your trading playbook. Whenever you're gapping green over red, which is what we saw today, expect pain for the shorts from in the box. If you're gapping red under green, expect pain from the longs in whatever sort of box if we're coming from a balance. Just a general framework to use when it comes to the market. So when I say in the intro that the market did exactly what it should have done, what I'm saying is that any shorts from in here who are feeling the pain this morning and wanted to close out offered this gap fill reversal, which is bullish off of the open, and then we saw follow through to the upside to make some sort of attempt to close the gap, which we did, of course. So the buyers are trying to step up, or even if you don't want to take it from that frame, you would say that shorts are getting pinched out of this market. And if shorts are not being aggressive here, then why would you want to tack on to their lack of strength and try to short this arbitrarily if those shorts are possibly adding upward pressure over 547? So the main point I'm making on the hourly chart here is just understand the type of participant in this market. Shorts are squeezing out. I wouldn't say for sure that we have dip buyers stepping up yet, but if we do spot a higher low over 547 and create an equal high, that to me would be an indication of dip buyers being alive and well in this market. So the pathing would be as follows. Right now we're slated to open around that, let's call it upper 552s, right? So that's somewhere in here. If we open in here and get any sort of pullback, I would be neutral in this zone, specifically looking for reversals in the bullish direction, noting that meta earnings are so far so good, looking for all the classics over 547, right? That could be a double bottom. It could be an inverted head and shoulders on the 5 or 15 minute chart. It could be a simple hourly hammer candle down here. If you spot buyers, note that on the hourly time frame, you're trying to build out a higher low, which is the beginning stages of a daily trend reversal. If we get consolidation that's high and tight, and we break out over yesterday's, or well, today's high as of the recording of today's video, but if we break Wednesday's high, then it's all about the Brigade bolt in this area and the right side of the V taking the trade after some sort of higher low has been produced for the equal high on the daily time frame chart, which is up here at 557.50 as we were just referencing. So those are the two outcomes that I would be thinking about. And if it's going to be bearish, we'll bring out the red crayon for this one for sure. It's got to be some sort of large breakdown on high tempo and then some sort of lower high that's set underneath 547. I'll use a nice little dot here for then the sort of exploration or attempt to make it back down to the equal lows, 10 points lower, 537. So that's really what I'm seeing from a pathing perspective headed into the end of this week. With the forecasted open for Thursday, again, a lot can happen between now and 9:30, but somewhere in this general zone, upper 552s. Let's see what other types of confluences we're getting with a Fibonacci, first of all, from top end to bottom end of this downdraft. I think that this is just like, again, it's so funny how this stuff works out. It's almost picture perfect. You can't make it up. Over this 61.8, the odds of a 100% retracement dramatically increase. What did we just talk about in terms of neutralizing the daily trend? That's sort of what we're looking for there, right? And on the downswing, if we're over the 38.2, I would argue that's a solid step from the buyers trying to prevent much more of a classic bear flag indication with just weak consolidation underneath that 38.2. And notice that this is loosely, it's about $1 off, but it's confluence with that 547 zone. And the general perspective is here to use this as a measuring stick. It's not precision math where, oh my goodness, 548.03 printed. It's not a perfect retest to the 38.2. Not the point, right? Generally, where are we in terms of this range division? lower third, middle third, upper third. It's really that sort of simple when it comes to Fibonacci's, and that's my take at least. You could probably hear a million different takes depending on who you ask on the internet. But let's finish it up with some anchored VWAPs here. This anchored VWAP represents all shorts since the beginning of this gap down from the Tesla and Google earnings debacle. And what you'll notice is that we're clearly above that anchored VWAP. I would argue that over time, this is going to provide confluence at the 547 as soon as like midday on Thursday. So be on the lookout for that. That would be a really powerful indication if the pullback is taking place and it is yielding confluence at that zone. 547, once again, being a key component. If we're trying to get an upswing, so let's just say that we're opening here, right around that upper 552s, if we're over the entire cluster of anchored VWAPs, how could you not be more bullish than bearish, right? So just trying to suggest where these big inflection points are, and I think I've really made the case clear that 547 is your arbiter or just your judge of price action on whether or not to be bullish or bearish as we come into the end of this trading week. Let's take a look at some market internals and really see what else is going on behind the scenes here. On the, I would say that the Tuesday breakdown is the most important thing to look at because it technically stopped the one time framing higher, which just means bar to bar higher lows on the daily time frame chart. We know that there was that large liquidation to the downside, but it was just bought right back up, or you could take the perspective that shorts squeezed. Well, is it just the heavy hitting companies or is it exchange level? Well, if we look at what was happening on Tuesday, here's Tuesday and here's Tuesday, there was zero evidence of stronger sellers hitting the tape at the exchange level. This is always, and the index score will be released soon. I promise you, I'm thinking maybe honestly this weekend, now that the kinks have been worked out. It's going to be released soon, but this reads mostly for the intraday activity. I would not look at this as a breadth indication. As a matter of fact, it's supposed to be the opposite. It takes the most concentrated components of the S&P and maps them so you can have confidence in terms of what's happening here. And this was really a result of the concentration effect we saw out of the Magnificent Seven. That's why I decided to build that indicator in the first place. But regardless, point being, going back to Tuesday, is there any exchange level selling? No. Is there, from a volume perspective? No, right? From an advanced decline line perspective, no. We're over the zero line all day and rebounding off of it into the afternoon. The cumulative tick hardly gets negative. I mean, it gets what is this? I've got to just entertain myself here. Negative 700 on the cumulative build. Remember that negative or positive 5,000 is a substantial read. So as the market's seemingly falling out of the sky and crashing and burning, oh my goodness, everything's so bad, the exchange level participation displays that there is zero participation from the sellers driving and really pushing their luck at the bottom end of this range. And if we take a look at the market profile, FYI, a little quick plug here for the tutorial. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Now we'll take a look at the market profile. And you're going to see a very similar indication, but the point is that the squeeze is much more in force, right? So where's the value area from the Tuesday session? It's technically lower, as is the point of control. So in theory, the index transacted more volume in the lower half of that day's session. And when we gap up over that high of day, anybody who initiated a new money short in that value area near that point of control, let's say that you initiated your short underneath the low of the Monday session, right, on that sort of very nuanced 5-minute lower high that was underneath, you can go back and find it. If you shorted here, you're screwed as soon as the market opened up this morning. So what I'm trying to get at is that the shorts are not being rewarded for taking risk at terrible location, and meta earnings are likely going to be a pressure in the upward direction. We're not seeing any exchange level participation for stronger sellers dead on the lows of the overall move from Tuesday. We do have a great excess low on the gap fill reversal, today's low of day, and we do have a poor high at the high of day. So is it possible that we need to take that high out to repair it and then see some sort of pullback? I would include that as a back pocket situation in your sort of strategy set or game plan for tomorrow. Let's jump back on over to the platform here and quickly take a glance through the QQQ NASDAQ 100. We'll do the same thing and see what we can learn about the types of participants, what the trends are, and what we should be thinking about. So on the QQQ NASDAQ, I have to have a bit more of a bearish edge out of this particular index, and the reason being is that the opportunity for a lower high to be set underneath the neckline of a very weak head and shoulders right shoulder. The right shoulder's hardly even there. The gap accounts for a lot of that breakdown, but this lower high is far more substantial than what we saw out of the S&P 500. You'll notice that the daily 50 SMA's confluence with the high of day, and in the post-market, we're just a hair higher than today's highs. We have 470, 442 by 49, and trading in the post-market here. So somewhere in this zone, right around in here, is where we're currently forecasted to open. Notice just the glaring differences between this and the S&P. So not only was it the structure that can still provide a beautiful spot for a lower high, not only is it still being underneath the daily 50 SMA, but it's also the fact that we didn't even close the gap today out of the QQQ. So if you're thinking about relative strength and relative weakness, it pays to, sort of be more of a long trader in the S&P and more of a short trader in the QQQ. It's been that way for a little while now. So I would still lean into this opportunity for a lower high as long as the open tomorrow morning is somewhere around this area, right? You've already broken out through this. If this is still a counter trend move in the context of a downtrend, here's your lower high zone, right? Still thinking about failures there. So how do you actually trade this? What's the action item, Matt, on the QQQ daily? If we open up here and look into the gap, I would be looking for a failure of that. And honestly, we could probably take it down to the hourly chart to describe this. So soak up the daily levels if you'd like. This is going to be your key inflection point, and these two are the big sort of rulers of price that I would be paying attention to. To give you the zones, we've got 475 to 474, bottom end of the gap, daily 50 SMA to the upside, and the downside is the top end of the multi-day balance, which is here at 467. All right, let's go down to the hourly, and let's learn a little bit more about the price action today and what we should expect going forward. So with the forecasted open being right around in here, if we look into the gap and there's a partial gap close and a subsequent failure underneath 474, 475, this lower high is sort of, in my opinion at least, a no-brainer short from point A trying to look for a point B rotation back down into 467. Now, when we get to point B, I would put my thinking cap on and say, okay, what's going on with the S&P, and does that have any bearing as to how we should be thinking about the NASDAQ? If the S&P is very strong and ripping back up towards highs, then I would not push my luck further than point B, and I would be looking for where's the double bottom, where's the inverted head and shoulders, where is it possible that we set some sort of hourly high or low up around that 467. So this short is a quick scalp to the downside, but I'm not convinced I would overstay my welcome if there's relative strength over in the S&P 500. If everything is falling off of a cliff, if the S&P is just as weak and trying to make it back down underneath its 47 mark that we were just describing, right, 547, that's a situation where I would hold on to the move, looking for an equal low past B into point C here at the weekly higher low zone 459.50, and that would be the downswing out of this. Now, on the contrary, if everything's strong, if Meta is holding up in the morning session and it's not really fading off of its gap up, then the situation would be to look for the higher low over this area. If there's a gap up, great, it would be a gap fill reversal. Very similar, honestly, to what happened here. Can we go for a gap fill reversal and then make some sort of new high? Can we go for a gap up, close the gap, and then make some sort of new high to close the gap overhead from, again, Google and Tesla? That's back here. That closes up at 480.15. Now, unfortunately for the NQ or just the QQQ cash, this is still an opportunity. I hate to be that guy, but it's still an opportunity for a lower high on the daily time frame chart, which is once again one of those threats worth distinguishing here out of the S&P versus the NASDAQ. So those are the considerations that I'm really keeping in mind for those two. The final point on the price action analysis here out of the NASDAQ is that the sellers have already actually failed once. And this was, if you tuned into the pre-market prep, you know what I'm about to say. We made a lower low on the Tuesday session, and the fact that the sellers tried to yield this lower high underneath the key level, which was here at 459.50, the fact that this gap up is now holding over the top end of the range just means that not only are sellers screwed from inside of the range, but anybody who is extremely late to the party is fuel to the fire in the upward direction. A lower low that cannot hold up for a lower high opportunity is always a dead giveaway that, at least in this case, sellers are running out of steam, right? So this failure is a back pocket sort of data point for bulls who are looking for possibly this gap to close overhead. Now, once again, I'm not sure that I would overstay my welcome on that particular idea. I would be taking profits as a buyer, right, as a bull, if we come into this from, let's just say, from a point A to a point B perspective. So if we're coming in, gap fill reversal, maybe this would be a trade idea, right? Through the opening print is your long to look through the gap, and then I would trim half the position, 3/4 of the position, whatever it might be, based on market context. Again, use your S&P 500 to gauge that, all right? So let's complete the sort of congruency test, which is just coming in with our Fibonacci's as well. From the top down to the bottom, what else are we seeing here? Again, love to see it. So the 38.2 is loosely correlated with today's high of day. Any holds above that starts to put the pressure on all of the shorts from this location down here. If they're going to squeeze out, the gap close almost seems inevitable. If we're going to neutralize the daily trend, we need an equal high, which is the 61.8. Any acceptance above that, and I would really be thinking more seriously about a 100% reversal. At that point, you're really starting to suggest, hey, here is, maybe it's actually a Man Ray pattern, something that closes the gap, finds a higher low above, and then does this. Now you're talking about a daily trend reversal, right? So one step at a time, I would say that as of right now with Meta earnings, I'm leaning a little bit more on the long side versus the short side, but not overstaying my welcome. It's more of a long side bias as a trader, and certainly being open-minded at these locations we've just described. Right? So that is your QQQ. We've also got the anchored view apps, and then we will move along to the internals and so on and so forth. So this, as it provides confluence with 467, means that any sort of attempt that looks into the gap, pulls back lower high that we firstly talked about, that's I wouldn't, maybe not screaming buy, but if that's confluence, I'm trying to take that trade all day long from point A here up to point B back for this equal high. Then it would set up some sort of ascending triangle, right? Where you've got a trend line now and this possibly breaks out. So we're getting a little bit heavy into speculative chart vision, but I'm just trying to give you the scenarios to pay attention to here in the QQQ. So that's the pathing I would look for there. The fact that this is barreling down on the gap close leads me to believe it's the correct thought process to be an aggressive sort of profit taker around that area and reassess when we close the gap at 480.15. All right, so that is your QQQ. Let's jump on over here to our NASDAQ internals, and you'll see a lot of the same. A little bit more weakness on the Tuesday session, and no surprise there. NVIDIA was down, over 6%. On yesterday's session, not Wednesday, but Tuesday. So seeing the volume outflows there, substantial move, of course, a little bit more negative here on Tuesday. The cumulative build closed negative instead of more flat. Not a shocker, but just the fact that today's session broke out over and held a higher low. Again, you can zoom in here and see this. The fact that we held that higher low over the top end of the 4 days worth of range, to me, more bullish here. Look at the internals, supportive of that, supportive of inflows, strong volume inflows, and a cumulative build that was positive on today's session. Let's take a look at the market profile for the NQ side of things and see what else we can learn about the price action. Let's get that centered up on the screen currently. And it's a lot of the same indications where your sort of value area was stuck down here. There is still a poor low that's lingering, so I'm going to carry that forward. But value area just is proving that any shorts who are late to the party got pinched out on today's session. As long as we're over the top end of this, which in the futures, I didn't give you the ES futures level. If you've been tuning into the morning shows, you know it's 55.20. But the top end of the QQQ balance is here at 19,380. We've also been very familiar with that level. Great excess on the lows, poor high at the highs. If we're going to make that move to the upside, here is that gap cycle to be thinking about. This totally aligns with all of the analysis we've conducted so far, in my opinion, with value clearly shifting and not even getting overlapping with the previous day's session, right? If this was going to be a more bearish day, value would have wanted to be like overlapping to down inside of this prior balance range, which of course it was not. Point of control was also higher as well. Let's finish up the broad market indexes with the IWM. Let's actually flip this back to our default view, and then we'll walk through some supporting evidence. We'll talk about the Fed and whatnot, and we'll get you out of here for tonight's session. IWM daily time frame chart. What's the trend here? It's certainly different than the S&P and the NASDAQ. It's actually up, right? We have lows, big rally to the upside, which we've talked about. Here's a set of higher lows. This is building out consolidation. It's been really choppy and sloppy, but there's a really nuanced take here, which is just that you technically have lows, higher lows, and these higher lows, if they can hold, really build more of a bullish sort of tone on the small caps daily. So if we can hold up over 222.50, this would be like ideal consolidation. My concern, and you're probably shouting it from the rooftops at me, is, Matt, look at the inverted hammer, look at the failed breakout. Absolutely, you are correct. So with this failed breakout, starts to come in some narrative for the S&P, which is that, our if-then statement, which is that if the small caps break down underneath the set of lows and target the equal lows here, and the NASDAQ is weak, let's just say that it can't close that gap all the way overhead, now I would look to your S&P and say, you know what? We're probably not thinking about these glorious longs to set an equal high up at that 557.50, right? That's not in the picture. If small caps are down, tech is down. There's just no way in the world that the S&P is going to buck both of the indexes and make its own way. So 222.50, this set of lows in here, you could fudge it down to about 221.75. If you're over that, bullish and still optimistic. If you drop it on the daily time frame chart, aiming for these equal lows at the bottom of the consolidation at 218. If we can stay over 218, I would say some hope is sustained, and we'll look for another attempt over 226 in the future. If we're below 218, Gets a little ugly looking left. There is incredibly thin structure over here. The deeper pullback, as we know, and we talked about this on the previous weekend update, 210. If we can stay over that from a weekly perspective, I would argue that we're still okay on the higher time frames, but in the interim, that of course would apply bearish pressure to the S&P index. So those are your major levels to watch, and yes, we are acknowledging that this is a failed breakout. We could take a look on the hourly time frame chart. So this was building pressure, building pressure, building pressure as an ascending triangle. Here's the Fed, and the market obviously does not receive the sort of carry through of Jerome Powell, all of that well. Now, it's not the end of the world because we're still holding that zone, but not the strongest display of strength into the afternoon. So pretty neutral stance here. If we're in this range, I would tend to be more bullish and optimistic for the S&P here and more bearish and pessimistic for the S&P when we are here. Keep it simple in the IWM. I really don't think that there's a need to complicate this particular index. We could take a look over at the participation at the not exchange, but just sort of index level, if you will. And this is, we're seeing strong volume inflows today. The advanced decline line was technically positive on Wednesday, or excuse me, today is Wednesday, of course. But so positive here. But Tuesday, what I was getting at is as the market was pulling back there, really not a lot of damage was produced. And this would be much more in line with what we saw out of the S&P 500. So not overly concerned yet about stronger sellers really hammering the Russell, which would of course be an issue for the S&P. Let's finish it up with the market profile on the RUT side of things. You'll actually notice decent excess high there. There's at least a couple of TPOs of excess in L period, which solidify that high. Notice just the incredibly thin volume up there. So I would argue any attempts to break out. So this would be back over on the platform. Let me get you the right number over here. 226. Any breakouts that attempt that again, I would probably look for them to go just because there is such thin volume in this. And in the Russell futures, the RTY, we're looking at 2,300 is really the level I would use. 2,300 is what we've been watching for a little while now, but you could treat it as a 10-point zone. That's a little wide in the Russell futures, but you get the idea. Any attempted breaks through this with a pullback for a higher low above, that's where the bulls are on parade. And if you're taking out these lows, that's where you get concerned. If we're thinking about value area, again, this does lead a little bit more towards the bearish analysis of the Russell, which is just that value area was here, value area was here, value area was here on today's session. On the attempted break, there was no carry forward from buyers really committing volume at price on that move. So once again, a little bit more dialing back the bullish nature and saying, hey, this is in fact a failed breakout on the RUT. Let's go back on over to the platform though, and let's finish up today's analysis with a look through all of our other supporting evidence components. Just zoom in a little bit further on this so it's top of mind. Let's begin with the sectors. Who was leading, who was losing, where was the weight? Communications are leading the pack so far this week, just up 1 basis point above 2%, 201 basis points. If you want to be fancy, basis points. Is that fancy or is that just normal jargon? You guys let me know in the comments. XLY. 199 basis points, or bips if you want to get fancy, 1.99%. And XLU is up here as well. Generally, let's get back on track, a little bit more serious. These two are more risk-on indications. Utility certainly more risk-off. I do want to acknowledge that semiconductors are up here as well, certainly outperforming the S&P on the week with this massive recovery off of NVIDIA today, really taking all of the loss from Tuesday back. So that's impressive. At the bottom end of the barrel, it's only two sectors red on the week. We've got consumer staples and healthcare, both of which are D for defensive. The only slight concern I have is that healthcare is a heavier weight sector, but as we'll see on the structural chart, it's really not the end of the world. The structural chart is trying to hold up over a breakout point. So the overall take is that posture is not all that bad as we're trying to make a turn potentially in the S&P 500. Communications, if we can stay over this 85 now on any higher lows, I would even say anything that goes back to this level, perhaps at 84.10, is still an opportunity to build out either weekly consolidation or the attempt at a new daily uptrend with the opportunity for higher low here. Let's not fail to acknowledge that this still could act as a lower high, but as of right now, you're getting sort of this range compression that's building out, not necessarily a clean trend. So the fact that we're over the 50 SMA, the fact that we've recaptured this, the fact that this is more of a risk-on indication for the broad market, slightly more optimistic in my view. If we look at the XLY, this is a little bit more of a threat just because the structure is so clear. If this overhead supply is going to persist, this inverted hammer is a great gap fill reversal opportunity, and the lower high is a threat. So any sort of breakdowns, I would argue back below 185.15 is where I would say, all right, looking for at least equal lows, that's a headwind for the S&P 500. So yes, it is performing well so far on the week, but I would not argue that it's a massive improvement for the actual structural chart just yet. Let's take a look at utilities. Inside of its balance range, huge gap fill reversal, but right back up towards these equal highs. Pretty impressive from today's session. If utilities break out, so take this one home with you. If utilities break out, and this is the right side of the V, so for anybody who's not familiar with that concept, right? Never the equal high breakout over here. This, after the right side of the V, after a huge higher low is produced, higher likelihood of going through. So regardless, now watch it. It's going to pull back again. But point being is that if utilities break out here and the broad market continues to try to make its advance, I would say that the posture is incorrect if the rally attempt is being led by utilities, and I would lean into the concept of a lower high in the S&P 500. If you can spot that lower high with utilities leading, it's a great opportunity to try to short it near the apex of that counter trend move because the leadership is all wrong, right? Let's move along to the semiconductors and see what's going on here. I mean, a huge opportunity for a weekly higher low, but again, the threat is that this lower high below the neckline sort of keeps us bearish, and we'll see a similar outcome here with NVIDIA based on its sort of struggle near the double top neckline. So not sold on the idea that semiconductors are about to flip bullish and really, kick this market back off to new all-time highs. I would have to see a recovery of that neckline at 255.70. As of right now, too much of a threat for that lower high. As we move along to real estate, not much going on here. It's obviously rate sensitive. We know that rates are pretty much guaranteed to come down, with Powell suggesting the cut come September. So not shocking to see this move in the upward direction. Lightweight, so if it makes a new pivot high, would be more impressed. We wicked above but did not close above, so still a little bit reserved there. Energy sector is trying to round out for some sort of bottom. You are sort of getting these incremental higher lows. Next phase is that your higher low has to stay over 91.75, the original double bottom neckline. Can we do it? Is the second time the charm? That is the big question. So in terms of market pressure, swing highs are important. If this breaks out over 94.80, great, bullish. If it starts to break down underneath 91.75, I would be concerned about the lack of a higher low, a little bit more bearish from that perspective. Industrials, huge breakout of the balance range. Yes, inverted hammer on today's session, but technically a new all-time high. Any higher lows over 126, good to go, bullish pressure. Let's take a look at materials, really lightweight sector in the upper third of its balance range here. Not much to comment on until it makes a new swing high, new swing low. Next up, financials, definitely worth talking about. Second heaviest weight component of the S&P. This is a beautiful higher low over 42.50, which we had talked about last week a ton. And now we've got the equal high. So two things are possible. We are looking for another higher low, or we're looking for follow through in the upward direction. No matter how you slice the cake here out of financials, looks really bullish. And as we'll see out of JP Morgan, some really solid setups in the financial sector as of right now. The tech sector, the XLK, the heaviest weight risk on sector, what do we see? Beautiful attempt at support so far. I would not say with any strong conviction that this is it. It must hold. We are good to go. We're golden. Not the case. I like the fact that buyers are responding near this location, but what do you notice about this? We did not see any follow through over those highs during today's session out of the XLK. So if you're trying to lean more into the bearish outcomes, and mind what's happening here in the post market with meta earnings, but if you're trying to lean into the bearish outcomes, what you're basically trying to prove or validate your thesis with is sustained weakness in the tech sector, even with meta earnings coming out somewhat decent, right, and offering a bit of a gap up. So the threat here, just like the semiconductors, is the lower high underneath 222. If we just reject that in the daily 50 SMA, not all that thrilled about a huge recovery effort in the S&P. And once again, you could tie this in with the utilities narrative. If the counter trend move continues, it's driven by utilities, and the tech sector is rejecting this for a lower high. Great, trying to find the short at the apex of the counter trend in the S&P 500. So this type of context is really what drives a lot of the trading that I do personally, but generally the understanding of the market, risk on versus risk off cycles. So these sort of scenarios and frameworks I think are important, and I don't know, I'm pointing that out more so in today's video than normal, but I am. Anyways, XLP, more concerned on a swing high, swing low. We're not there yet. I would argue that this is somewhat progress in the upward direction. It's a risk-off sector, but we don't want it falling off of a cliff, so fine, decent progress there. XLV, as we were saying, it's technically a red sector on the week, but notice what's happening from a technical perspective. Awesome looking, possible Brigade bolt here into blue sky territories over 148. Third heaviest weight sector for the S&P. You're not going to have a sinking ship if this is playing nicely into new all-time highs. Let's take a look at some ratios and see what's going on from that point of view. We are getting a sharp rebound here, but still in a downtrend, so this still continues to be a red flag. I know that's white, but pretend it's red. This is a big helping force. I love the acceleration off of the recapture of the 50 SMA. This is beautiful. This is okay, I would argue, because of its weighting and technically risk off though. And I like the opportunity for this higher low. It's just got to prove it and hold now by making some sort of equal high and breaking out. So again, it's very hard to look at this market and say, oh my goodness, this huge risk-off rotation is taking place, sell everything, the market's going to zero, when your top-weighted sectors are still looking this way. If all of these were pointing in downtrends like this, like this, like this, like this, much more of a concern, but right now that's just simply not the case. Your risk-off indications look like counter-trend attempts to build out uptrends that are rolling over. This out of utilities is the concern, and we talked about that at the top end of the range as well, so keeping a close eye on that one. Let's take a look at the risk on-off grid. This is doing what? Small improvement, but negligible. This has virtually zero improvement, still strong opportunities for rejections of that. So this tells a slightly different story, a little bit better out of apples to apples here, consumer discretionary versus staples. And then if we look at semiconductors versus healthcare, you're holding up over that, let's round down there and call it 1.5, round up, excuse me. So okay, but these are not helping the case for the long. So I think that the approach we've sort of outlined in the S&P, which is so far like being open-minded to that reversal, but not wholly convinced that, oh my God, new all-time highs are going to be here, right now, is the proper approach. It's like, okay, these are a little bit more aggressive pullbacks. Is it possible that weekly higher lows are attempting to be found? To me, that's the more logical sort of approach. If we look down here, we brought this up a couple of episodes ago, the USD JPY for the carry trade. This has more aggressively broken down underneath, which could be an explanation for the divergent credit spreads that we're about to get into. Let's move into, let's take a look at the dollar first. So this is just the dollar in isolation. It's been pretty stable. Not much to comment on out of the dollar. If this breaks down, which again, it could very well do with the easing of monetary policy, downward pressure here has to put back upward lift on the broad market below. That would be my take at least. Gold is breaking out, so maybe thinking about this as a tailwind for equities in the relationship of the dollar hopefully moving lower on this gold breakout, right, as expressed as a currency. If we look at interest rates, they continue to drift in the downward direction. Jerome Powell basically solidifying today that, hey, we're very likely going to cut rates in September, right? So that's the 10-year, well underneath at this point, our 4.33. If we take a look at the inverted ZT, continuing to drift in the downward direction, huge move lower on today's session. Again, all of this is adding up to the market pricing in the September cut pretty accurately as of right now. I would say it'd be a pretty big surprise if Jerome Powell did not cut rates in September. One of the things, if we just take a look at a couple things. So first of all, here's the tracker tool. First of all, it's 100% odds that we are expecting a cut. There is no probability of some sort of hike in the September timeframe, which seems correct. But we've only got about 87.5% odds here versus a double cut. Now, I don't think that a double cut would be appropriate, probably going to spur back inflation too aggressively. But if we take a look at the statement from the Fed today, this is the strike-through version. Notice that this replaces, and this is a huge point because this line right here, the committee remains, this is the strike-through, right? The committee remains highly attentive to inflation risks, has been in this statement for years at this point. And this is the first time in literally years that the Fed has acknowledged both sides of the dual mandate. So not only is it price stability, as we know, but it's also maximum employment. And if you take a look at the calendar here, we've seen over the course of this week, the labor market still looks pretty robust in terms of job openings. Now, again, the mismatch between type of job opening and who's needing those jobs could be different, right, which is an issue, but the job openings are there. It's not like there are no jobs to be found and nobody's hiring. There is still some hiring taking place. The ADP non-farm is a little bit of a miss now. But what do we know about ADPs? This has historically sort of been the lag to what we've seen over here out of the non-farm. Right, the non-farm has smashed the ADP in the past couple of sequences because of the government hire, right, and the non-private sector here. So watching out for that on Friday. But Jerome Powell is watching these job numbers like a hawk. There's no indication of inflation here out of the ECI on today's session. And the acknowledgement there was basically that, hey, we're positioned right now to be extremely flexible. If we get data that looks awful and the labor market's sort of not looking great, I believe a quote, and you can go back and watch his spiel there, but a quote was, we've seen a better balance come into play out of the labor market, but we don't need any more of that balance. Basically what he's saying is that, hey, any more red flags in the labor situation and we're going to be cutting rates, which is pretty much aligned with what we know about September. Why would you hold rates higher if you're starting to see a slowdown in hirings? This is the private. We'll see what the public comes out at on Friday. without risks to inflation, at least from an ECI perspective, right? That was today's data, at least. So that's sort of what I'm seeing from this. And as we know, there were a lot of comments from the Q&A where people were saying, like, are you fearful that growth is going to slow down? And Jerome Powell just keeps peppering back with his age-old sort of rinse and repeat answer, which is, no, we're going to be data dependent. There's no issue with growth right now. We got through a tough period of inflation in the early stages of this year. We're sort of through that. We're seeing meaningful improvements. And as you just saw on the statement tracker, this is huge. This is huge. So anyways, that's your fundamental spiel here from Jerome Powell on today's session. We didn't learn anything dramatically new, a lot of status quo, but I thought that was worth pointing out. PMIs from the manufacturing side will come out tomorrow morning at the 10 o'clock time frame. We're looking for some contraction here still. Obviously, you're going to want to watch this like a hawk. We'll be live on the pre-market prep for this one at 8:30. The unemployment claims, initial jobless, is that still stable? He even acknowledged that, and I thought this was so funny. He was like, yeah, initial jobless claims are technically higher than they were throughout this duration back here. However, from a historic basis, the labor market's just come back into a better balance. It's not that we're seeing these outrageous reads out of the unemployment claim. So I found that to be pretty interesting that he acknowledged a specific data point to back his claim. Anyways, that's what we've got for the rest of the week. As we take a look at the earnings calendar here, we know it's all about Meta, ARM, Qualcomm. They were after the close today. We'll check in on all of these charts. Mark my words, I will not forget about ARM and Qualcomm. And then into the remainder of the week, I would say that these obviously up here, your top watches, and volatility could come back into the market. However, I think after Microsoft sort of set the tone with, hey, we sort of, the headline was a little bit deceiving, right? Things are slowing down from the AI perspective. But then in the conference, they said, no, we're seeing continued growth. We're continuing to invest in AI. We're seeing the demand there. And then obviously everything moved back higher. The big deal here is that Microsoft's announcement, or at least their clarification, really spurred, because they almost announced an exclusive partnership, not quite exclusive, but almost. They're spending like 60% of their infrastructure spend on NVIDIA chips, which is just like, maybe it's crazy, maybe it's not, depends on how you feel about AI, but that's huge for NVIDIA, which is one of the reasons why it erased all of the sort of fall off from yesterday, right? Anyways, that's your brief fundamental conversation about what's been going on here. AMD also gapped up big time but faded all day. AMD sort of suggested that they're really diving into the AI space, trying to make those AI chips and have that be a cornerstone pillar of their business. But the competition, and again, just the outright saying from Microsoft, hey, we're spending on NVIDIA chips, meant that gap up faded for a majority of the day. We'll get into these technical charts in just a moment. So with that, we'll jump back on over to the platform. We'll continue to assess the risk appetite for the market now that some of this news has come out. What are bonds doing? No surprise here that in the short term, they're rolling over because short-term yields are about to, in theory, go down with rate cuts, right? And the longer terms are running a little bit more stable, I would argue, instead of developing these sustained downtrends and trajectories here. Overall, I think this is fine and wouldn't really suggest anything impressive about risk appetite. If we look at credit spreads, this is where that yen carry trade is starting to become a little bit more of a maybe indication that credit spreads are widening a bit. But generally, I think that this comes with the uncertainty of sort of what we had with the Fed. We'll see if this starts to correct itself back lower into the end of this week or early next week. High yield junk, bullish divergence, clear as day with the broad market. However, remembering the higher time frame bearish divergence still, and this is, I think this context is a must sort of explain, right? You can just see the difference between where we were here, and here versus the I mean, just take a look. Right, take a look on a relative basis, not nearly the same. You could even argue that if you just do something like this, hardly broken out above, huge breakout above, right? So generally just trying to bring us back down to reality. There is a bullish divergence out of this, but it doesn't necessarily mean that the market has to go to the moon. I would just argue that it means the market's probably not going to crash. Would be my response to that sort of outlook here. If we look at Bitcoin, stable, not much going on there. I would argue that's fine for risk appetite. This is huge and sort of reinforces what we were seeing out of the internals, which is just that breadth is improving as this market is trying to turn around off of these lows. Even if it's just a counter trend move, breadth improvement here is pretty notable. You can see the same thing in the SPX A50R, rotating back up to the highs after setting a higher low. So that to me is impressive, perhaps the most obvious. RSP, just complete, like, let's zoom in a little bit on this so it's about equal. This versus this, I mean, how clear is that? Breadth is accounting for a lot of the sustained sideways action here versus the more weakness that we've seen out of the NASDAQ, which again is not a shocker. Here it is on the QQQE, where we're technically underneath that level, right? The equivalent breakout point. So this is all making sense in terms of intermarket relationships. Volatility is still elevated in my view because of earnings that are still yet to be seen. Amazon, Apple are going to be huge. If those things resolve positively, I would imagine that this comes down underneath 15. If they start to not resolve positively, that's where I would be more concerned and say, hey, VIX staying elevated over 15 after earnings, something's not right here. This is still feeling a little bit more so like a counter trend move until proven otherwise. Let's take a look at the VVIX and see what's going on here. Still elevated, again, not quite yet underneath its handle here. If it were to get below, that would be a little bit more comfortable. And here are the volatility futures on a pullback towards deeper backwardation, but not under the zero line yet. I would not be overly concerned about this. This looks like it's about to pop over zero. So generally speaking, volatility, in my view, is totally a side effect of earnings as of right now. Let's take a look through the core list of companies, then I've got a couple of trade ideas for you. Here is Microsoft. Daily time frame chart is up first. You'll note that the earnings expected move are these blue lines, right? And on the move today from Microsoft, I mean, in the pre-market, yeah, there was a huge move to the downside, but it basically recovered back into the prior day's range unchanged. So market makers are not caught off guard. I would argue that this is a look below and fail on these lows. And if anything, there's the opportunity to target the top end and this lower high here at 432.15. So a very simple watch out of Microsoft tomorrow will be to say, if we open on a gap up, is there a gap fill reversal? In which case, target 432.15. If we open inside of range, any breakout through or a Brigade bolt over the previous high of day is supportive off of this low, look below and fail in the lower wick, target the top end over here. Here it is on the hourly time frame chart. You could even start to make the argument, and maybe this is a bit of a stretch, but there's your daily trend reversal over the neckline. Here is what we were referring to. If we open here, get some sort of Brigade bolt over your previous high of day, target top end of the range here. If you want to be even more conservative, fine, look for something that looks like this. It's point A to point B up here. Better long trades over that 432.15 based on the double bottom that we were just describing. If it's going to be bearish, it would need to be consolidation on these lows and a clear hourly lower high underneath 416, given that there was no acceptance from the sellers at the lows of today's session, even with a misunderstood earnings catalyst. Next up, Apple. They're going to report earnings after the close tomorrow, so I'm not even, take this for what it is. If we take a look over at the trade tab, it looks like currently, and this is probably going to change throughout the session tomorrow, but roughly an $8.50 expected move up and down from the earnings sequence. So maybe something up towards this 230 or maybe something down towards this 212 would be reasonable. As of right now, I would be thinking about the lower high opportunity here underneath this shelf. But once again, earnings is going to obliterate anything I say on this, so I am going to bite my tongue. NVIDIA is much further out, so we can have a conversation here. My concern, and maybe this is a hot take, maybe people don't like this take based on what happened today, but the fact that we're still underneath the neckline of this double top right here, this zone, 115.75 to 118, would lead me to believe that there's still a strong opportunity for a lower high and the disappointment trade, as I'm calling it, for the semiconductors. And I'll just give you one of the trade ideas. It's just a check-in on SMCI. It's the same concept, so I'll throw it in here at the same time as NVIDIA. This is huge, right? I mean, look at the amount of, if you bought this here, oh, finally, it's making new all-time highs. I'm going to get suckered into SMCI at the top of the parabolic move. Anyone who was like, oh, I'm going to buy the dip at this equal low. If we're underneath all of this overhead supply, and now just correlate this back to NVIDIA, right? If we're underneath 708, thin structure, this can close all the way to, like, the next major area where there was a little bit of a hang-up was at 500. So 708 down to 500, 200 points of range to be aiming at? Absolutely. That's still on my radar as something to be thinking about. So SMCI on the short watch, if we can sustain price under 708, drop the 200 SMA, opens the door for lower. Back to NVIDIA, take that same concept and apply it to what's happening here. Oh, I bought the sort of move back up over this. I never made it to the equal high. I'm still holding on to this. You've already broken the big heartbreaker level. Opportunity to short this now up against that heartbreaker level if we can spot the setup now. I want to be clear. Today was a solid green-bodied bar that closed strong near the highs. It completely wiped out the red downside move we saw yesterday, which technically made a lower low. So the sellers are not getting the follow-through that perhaps they were looking for here down on the lows. if we can spot weakness, if we can spot a daily inverted hammer that prints and brews, maybe there's a setup that forms to take us back down to the equal lows, but I would not blindly be short here just up against this level. Taking it down to the hourly chart, notice that the uptrend and the breakout into the afternoon was sustained here versus breaking down below. So how might you trade this on a smaller time frame? If this is going to be a head and shoulders, a lower high tomorrow morning that flushes underneath 115.75 could initiate the short down to the low, then looking for thin structural retracement here. It would be from point A to B, reevaluate at B, and then try to hold some runners into point C, watching to see if we get follow through from there. If there's no acceptance, or let's just say if there is acceptance rather, over 115.75, then I'm not convinced that it's just an obvious short. So there's still all that overhead supply, but that's how I'd be trying to navigate this one. GOOGL is up next. Earnings in the rearview mirror. Let's take a look. Very gappy chart. I think that this is a beautiful spot for a lower high based on today's session. Already rejecting there underneath the bottom of this previous supply. So just watching for consolidation and any sort of breakdowns underneath 170, trying to aim for the equal lows at 166.15. Here it is on the hourly time frame chart. So very, very grindy move in the upward direction. You did not have any buy side momentum. There was no sort of short squeeze in here. Excuse me. And anything that drops today's low, I would just be aiming for the equal lows down here again, 166.15. If it's going to change my mind, it's got to be consolidation here, and then we're only trading the gap framework, point A to point B up here. Next up, Amazon. Let's see what's going on with Nancy. Ugly, sloppy. We've been talking about this in the pre-market prep. This is a balanced range. This is a huge failed breakout. This is looking like acceptance back within the range. It looks weak. There are earnings obviously tomorrow after the close, so I will bite my tongue. But even without earnings, this chart structure here is not attractive whatsoever. I'm not seeing the obvious setup to conduct here. Perhaps there's an argument for some sort of head and shoulders, but we're currently not near the neckline, so we'll take a pass on that. Next up is the metaverse. Where are we slated to open? So I'm referencing this box right here, 509 by 509.30 in the post-market spread. So somewhere up here. Looks like a huge gap up is going to stick through the gap from the sympathy move on Google and Tesla. And this is actually very impressive because what it does is it puts us over this 493 overhead supply. So now the opportunity is that if the gap fades and we can hold over 493, that's an awesome opportunity for a possible higher low to change the tone out of the metaverse. All right, so 493 is a huge watch for this reason right here. You can see prior support, then offered a lower high underneath. If we can now pull back, partial gap close, leave this unfilled, leave half of the earnings gap unfilled, and support over it, that would be a pretty big recapture, in my opinion, back into this overhead range. You would target firstly the high of day or whatever, then beyond that, this would be your target to the upside at 528.50. To the downside, if it goes beyond 493, this is like a no-brainer gap close under the 493 into today's high of day. Let's move along, and of course, let's really play it out. This would start to turn into ugly, but there's sort of like a head and shoulders. Big time lower high, equal low breakdown from here and here. Door is open for much lower. Very, very speculative as of right now. I would tend to think that this is a primary outcome to at least be considering. Next up, we've got Tesla. What's going on? And gap rules will be enforced there, all right? So tune into the pre-market prep if you're not familiar with what those are. We'll talk about them then. Tesla daily time frame chart continuing to bang its head up against the bottom end of the flag consolidation here, not able to close that gap overhead. So in my view, it leaves a little bit to be desired. I would maintain the bullish stance if we're here and be optimistic for the Brigade bolt, if you will, over the 234.15 into 246.25. But if it just consolidates and then drops into range, then it's a look below and look above, and fail. The only reason I'm slightly more optimistic to the upside and sort of thinking about, all right, can we get this, is because the look above and fail had already attempted to unfold once. This morning's gap up and over the top end of this range would lead me to believe that stronger sellers are not participating, or sellers who got trapped down here closed out, and now we're seeing bullish acceptance over the top end of the original range. So if we're here, it's got to be bullish, and this is the actionable idea from point A up to point B. If we drop below, it's got to be the lower high underneath, and that is where I would say, okay, technically the bottom end of the range is always the target. Next up, we've got JP Morgan. What's going on with the banking sector? We talked about financials already. If we can hold up over this, this is bullish, looking for the equal high breakout. That's blue sky territories above. Unfortunately, for JP Morgan, it's not in the tech sector. It's not getting any sympathy from the meta move higher. So this is neutral until proven otherwise. I would not be short underneath these equal lows because of what's happening here. I would be thinking about this. as a Brigade bolt back over that if we test it to try to find the next daily higher low after this sort of brought in a fake breakdown. So JP Morgan is neutral up here, trying to trade for the Brigade bolt up there. If we test, not taking the short through the breakdown of these equal lows, but instead trying to Brigade bolt it back into the range to target the top end at 216. Next up, we've got Netflix. There's not much to say about this chart. It is horrific. Let's take it to a daily. And the only comment is just that this possibly is a falling wedge, which is a bullish pattern. If you break out of that to the upside, the top end of this range would be the target, but do you want to trade through that is a question that you have to ask and answer for yourself. This is a horrifically choppy range, and for me, I don't know that the gray hairs are worth it. Next up is AMD, and what do we see out of this? This was the earnings expected move high, basically gapped into the bottom end of this overhead range. You could think of the exact opposite, which is happening right now out of Meta, right? Out of Meta, we said, hey, if we open here, pull back and hold above, that's bullish. Well, AMD did nothing more than gap into the bottom end of the overhead supply. Anybody who was long from up here, who wants a get out of jail free ticket, sold this as soon as the market opened up for as close to break even as possible. This is a huge opportunity for a lower high. I would not be optimistic whatsoever out of AMD based on today's daily bar and the reaction from earnings. A stronger earnings move should have poked you up and into that range, then offering the opportunity to recapture it a little bit more meaningfully. Obviously, that was not the case on today's session. So bearish AMD, I would say consolidation in here doesn't really leave us with tradable opportunities because of the range that was traveled today. But if we can poke under 143.25, equal lows are the target. At least you can manage risk up against something that looks like this for your risk-reward boxes. All right, first trade idea outside of SMCI is UNH. And this is another check-in idea. But instead of being bearish this time around, we are actually looking to be bullish on an equal high breakout. If you can move, oops, we want to get rid of that. We don't need a dollar sign. The UNH still. If we can break out through these equal highs, rock and roll, it's blue sky territories up above. Any consolidation in here keeps that trade alive. And the reason that this is coming back up on our radar is simply noting that when we were talking about the inverted hammers breaking down, how much follow through was there? I mean, we did get the breakdown technically, but this was thin structure. The idea was to make it all the way down to 545.65. It promptly failed, found a higher low above, and now we just keep pressing the top end of that range. So over 580.35, blue sky territory breakout here out of UNH. We already talked about SMCI, so I won't bring that one back up. That would have been number 2. Number 3 is TTD. This is the trade desk, and we'll go to a daily time frame chart. Look at this upward channel that, of course, has failed on big momentum. So we'll just do something that looks like that. There's your big momentum fail. This is a huge lower high, well underneath all of these prior lows. And if we can get the equal low flush, this is an inside bar, technically a bearish 3-bar play. You could even call it an H pattern here. If we are under 89, I think that there's a quick day trade scalp that can take place into 87.25. The reason that I would pick that level out is here on the hourly time frame chart. It is the origin of this rally in the upward direction, right? So 87.25. And again, this is not a huge trade. This is not, oh my goodness, we're shorting this thing into the ground, but there's a very scalpable opportunity here underneath 89 into that level we just described. Even on the hourly time frame chart, this is starting to look like a classic descending triangle, or as Lance likes to call it, the bouncy ball pattern, right? So another subsequent lower high, equal low flush, there's your short. That's the trade desk, and the final trade idea is on a not as good stock, but we'll go to Roblox. RBLX is the ticker on this. And what I wanted to point out about this one is the beginning stages of a break. I guess I maybe wasn't accounting for earnings here. My apologies, folks, on that. So in real time, my assessment would be tomorrow. If we can hold up above, great, but I would not overstay my welcome on earnings. Earnings are before. Sorry, completely disregard. If we open, earnings are tomorrow before the open. I thought that they were going to be after the close. They're before the open. Was this on the earnings calendar? Where do we see anything? No, nothing out of the major names. And I guess Roblox is not a major name, but I figured they would include some of these, quote, fun stocks, if you will. Regardless, if we're over 41.10 after earnings, I would tend to think that this is breaking out of, classic pennant, bull flag, whatever you want to call it. If we're underneath, I wouldn't really touch it. I just don't think that the juice is worth the squeeze on the downside there, battling against this trend that has been formed over here. So that's my take on this Wednesday afternoon. Hopefully you guys had an awesome trading day. We'll see you tomorrow morning up in the penthouse suites for a full pre-market prep with the promise of at least the first 15 based on cutting out early from today's session. So with that said, have a green trading week. If I don't see you, we'll hope to see you, but if I don't, have a green one, and we will catch you in the next one.